And even if this is the head and shoulders pattern right here, right now, 2008 to 2010, the shoulder, head, shoulder. Now, even if this head and shoulders pattern bounces off the bottom and goes up, we still have some dangerous patterns over here. This is called the broadening top formation. What happens is you have higher highs, which is good because the price keeps going higher and higher, but the lows are lower and lower. So instead of the price moving up in a normal way, it kind of broadens out. And if the price keeps broadening out, it's just going to keep bouncing up higher and lower and higher and lower and very volatile. So this is usually a top formation also, and even if we break through the head and shoulders pattern, there's still going to be a lot of trouble at the 12,000 level over here in the broadening top. Now, what happened in the Great Depression and what could be happening now is something called the dead cat bounce. Now, it's called the dead cat bounce because, it's a kind of an illustrated term, but if you imagine it, imagine a cat falling down from a building. It bounces. If you throw a ball from the top of a building, when it bounces off the ground, it's not going to bounce to the top of the building again. It's going to bounce maybe a couple of feet up in the air, but maybe halfway up, but never up back to the top. So it's called the dead cat bounce because the cat bounces down, it dies, it bounces up, but it's a dead cat bounce. It tricks us into thinking that maybe it's alive because it's bouncing, maybe it'll bounce even higher, but eventually it reaches its top and it drops back down. Now, that's exactly what happened in the Great Depression over here. You have the Great Depression top, we have the the recession just like we had in our market. Then we have the dead cat bounce, which formed the head and shoulders at the top. See, so this is considered the dead cat bounce because it tricks people into getting into the market over here. But it's actually just a reaction. It's actually dead over here, but it bounces back up. Then it loses its steam and it falls all the way back down to form the Great Depression. And the question in our market is, we reached the top, we fell back down, terrible recession that we lost more than 50% of our market over here. And then the question is this the dead cat bounce over here that forms the head and shoulders? Is this just a trick of us thinking that things weren't as bad as they really are? The next potential issue we have with the market is wave progressions. This is Robert Prechter's Elliott waves. And the way things work with waves is, since everything has a mathematical formula behind it, everything in the world, or human behavior even, or the market behaves in a mathematical way, what we have is a five-way wave formula that is an impulsive wave, which is the growth phase right here. And after the growth phase of 5 waves, we have the corrective phase, which drops back down to correct the growth. Because you can't have something growing all the time. It has to correct itself and return a little to normal instead of being overextended. So what we have with the Elliott waves is we have wave 1 goes up, wave 2 corrects it, wave 3 is a growth phase, wave 4 corrects it, wave 5 is another growth phase. But after these 5 waves, we have a correction phase that takes us back down. Now, if we apply this to the market, this is Robert Prechter. He predicted this in about 1999. And what he saw was from 1932 till 1999, we were in a super cycle. And this super cycle goes all the way back to the 1790s. And what he said was, this is the top of the 5th wave of the major super cycle since the 1790s. What that means is that this is the ultimate top before a huge correction, the biggest correction since the 1790s. But if you break it down, what you have is 1, this is wave 1, which grew from the Great Depression. Then you have 2, which corrected. You have 3 over here. You have 4 that corrected it. And then you have the long run up from the 1980s till right here. And what he actually predicted in 99 that the technology bubble would burst, which it did. And so this is a very dangerous signal with wave theory because it helps predict a lot of market turns. Now, if we put that into our market now, this is the Dow Jones from 1900 till now, to 2010. This is wave 1, which is the top of the Great Depression. Wave 2 was the correction of the Great Depression all the way back down. Wave 3 grew it again. Wave 4 corrected it. And wave 5 is up here. This is the top of the technology bubble and the top of the housing bubble. So if this is the end of the 5th wave, what we should have from here is a nice big correction that takes us somewhere around here, Dow 1000, Dow 4000. Either way, we're due for a big correction over here according to wave theory. Another thing Robert Prechter pointed out in the Elliott waves is in every corrective wave, which is right here, the bottom, right here, 2 and 4, at the bottom of every corrective wave was one major war. We had the Revolutionary War at the bottom of one wave, we had the Civil War at the bottom of one, World War II at the bottom. And if we're at the top over here, top of a wave, of the 5th wave, and we're going to correct, that could signal another major war. That's just something to keep in mind. Now, another issue we have with the market right now is the housing prices. If you look, these are from 1970 to 2010. These are the U.S. house prices. The straight lines, if you notice that, those are the trend, the pre-bubble trend of the housing prices. And these are the actual prices right here. And if you notice, you'll see that the prices were relatively close to the trend from 1970 all the way to about 1998. But from 98 till 2006, they deviated so much from the trend that instead of over here, the trend would have called for an average price of about 125 to 150,000. But at the same time, 2006, instead of 150,000, housing prices were about 250,000. So right here is the housing bubble. As you can see, this is a huge bubble compared to where prices should be. And what happened from that bubble is prices dropped all the way back down, and they're very close to the trend. Prices dropped from 250 closer to 175,000. Now the problem with this is, just like, well, it could be a good thing that prices have corrected and we're near the trend, and this could be a good signal for the market that we're heading up. The problem with that is, just like we overreacted to the upside, there's a decent chance that we could overreact to the downside. So it's like a pendulum. It swings up to an extreme, it's going to swing down to an extreme, and then it corrects. So the question we have now is this the bottom of the housing market right now, or are we due for an overextension of the correction? Now this is the market 2003 to 2010. This is the top of the Dow at 14,000. This is the bottom of the recession right here, 6,500. What happened is we dropped 53.5%, and we bounced up 72%. The difference, however, is we're 21% away from the top, where we were right now at the top of the head and shoulders pattern right here. That's 21% away. Now, one way we see how the consumer is doing is the Consumer Confidence Index. This tells us how confident the consumer is, and we need the consumer to start spending and to be happy in order for the market to really recover. Now, what happened is, from the peak in 2007 to the trough over here, we had about a 77% drop. The Dow Jones only dropped 53.5, so the drop in consumer confidence was about 20% more than the market. Now, we had a nice bounce back, which is on percentage terms bigger than the Dow Jones, but the big issue here is, while the Dow Jones is only 21% away from the top, the consumer confidence is actually 44% away from the top. So the difference in consumer confidence is actually, we're twice as far away from the peak than the Dow Jones. And since the consumer is very weak, that could be another issue for the market right now. Another very dangerous sign in our market right here was the volatility index, which is the VIX, which shows us how it's called the fear index, or how fearful the market is. But what we have here is, in 2008, the VIX reached an extreme high at 90. And from 2008, from the huge fear that we had in the market, over the past 2 years, we basically gradually dropped all the way down to 15, which is a good sign because it shows people are less afraid and the market's going up. But what happened recently in April is we had a quick spike in the VIX, and it's right here. It formed a triangle pattern, or a pennant. And this is actually very scary for the market because after a long gradual decline in the VIX, to suddenly have a spike could show us that there's some new dangers coming up. Another long-term valuation of the market that we have here is the S&P 500 dividend yield. And what you notice here is when the dividend yield is very low, that usually signals a top in the market. So right here, right at the top, right before the Great Depression, we had the lowest dividend yield in history, or since the 1890s or 1880s. And at the peak of the technology bubble, we had the lowest dividend yield again. And this is where we are right now, 1.94. And as you see, basically this is extremely low compared to historical standards. And this could signal another top in the market and a new drop. Another way to value the market is the S&P 500 PE ratio. Again, when this peaks right here, you see that the market drops from there. But right here at the top right before the Great Depression, 1929, you have PE ratios of 30. This is price to earnings ratio, which basically tells us how much people are paying for the earnings of the companies. So right here, people were paying 30 times what the companies were going to earn. And 30 is extremely high. The average is actually around 16. So right here, this was the top of the market, drop back down. Right here, up top, this is the highest PE ratios of all time, was the top of the technology bubble, and that was near 45, and from there, we dropped a lot. Now this is us right here, 20.76. If the average is 16, 20.76 is still above average value, so we can't really say that the market is undervalued. We could say it's close to fair value, but we can't really say it's undervalued if it's at 20.76. Now, even though this is lower than the technology bubble and the Great Depression, this is still a dangerous sign right here. Another thing that people have pointed out to is the mutual funds cash to asset ratio. What this is how much cash the mutual funds are holding in their portfolio. And when the cash levels are really low, it tells us that the mutual funds are basically pouring all their money into the stock market. And right here, you'll see that when it's really low at about 4% or 3 point something percent, or even here, at all the lows is where the market reaches peak. Right here in the 70s, it reached the peak when mutual fund cash levels were low. Right here at the top of the technology bubble, 4% was really low. Top of the housing bubble, right here, and this is where we are right now. So even though it seems that everyone's afraid to invest right now, mutual fund cash levels are actually very low, and it could signal that there's no more money to be invested. The market's going down from here. Another way to measure the market value and historical value is the total market cap to US GDP ratio. What this means is the market cap of all the companies in the market compared to the US economy, the gross domestic product, the GDP. Right now, we're at 80.4%. That's the ratio right now. Now, if we compare that to the historical average, the average is basically around 60%. Right now, we're at 80%. So once again, just like the price to earnings ratio, the PE ratio, we're not as overvalued as the technology bubble, which is 181% right here, or the housing bubble, 146% right here, or the Great Depression right here, 88%, but we're still at 80%, and that's still above fair value. So just like the housing bubble, we reached the top, and we might need to bounce even further down to correct it. So we can't really say we're undervalued according to the market cap as percent of nominal GDP.